This question tests students' understanding of the accounting treatment for debt securities under US GAAP, particularly the effect of reclassifying a security from available for sale, AFS, to held to maturity, HTM. The key concept is the treatment of unrealized gains and losses. Available for sale, AFS, securities are measured at fair value, and unrealized gains and losses are reported in other comprehensive income, OCI, a component of comprehensive income, rather than in net income that held to maturity, HTM, securities are measured at amortized cost. After the transfer, future unrealized gains and losses are no longer recognized, because the security is no longer measured at fair value. Therefore, students should focus on how future unrealized gains and losses are treated after the reclassification. Comprehensive income will be impacted in the future by unrealized gains/losses. Incorrect. After the security is reclassified to held to maturity, it is carried at amortized cost, so future unrealized gains and losses are not recognized in OCI, comprehensive income. B. Net income will not be impacted in the future by unrealized gains/losses. Correct. Held-to-maturity securities are not adjusted to fair value each reporting period. Therefore, future unrealized gains and losses do not affect net income or OCI. Interest revenue continues to be recognized using the effective interest method, but market value fluctuations are ignored until maturity or impairment. C. The balance sheet will be impacted by unrealized gains/losses. Incorrect. Once classified as held to maturity, the investment is reported at amortized cost, so future unrealized gains and losses do not affect the carrying amount on the balance sheet. D. No change will occur regarding the accounting treatment for unrealized gains/losses. Incorrect. The accounting treatment does change. Before the transfer, unrealized gains and losses are recognized in OCI. After the transfer, they are no longer recognized because the security is measured at amortized cost. Correct answer. B. Net income will not be impacted in the future by unrealized gains/losses. A useful memory aid is trading income. AFS, OC, HTM. Ignore market value changes until maturity. Therefore, after a security is reclassified from available for sale to held to maturity, future unrealized gains and losses no longer affect financial performance, making B the best answer. This question tests students' understanding of how different transactions affect components of shareholders' equity, particularly retained earnings, RE, and additional paid-in capital, APIC. The key phrase is would affect retained earnings but not additional paid-in capital. Students should recall that retained earnings accumulate net income minus dividends and are affected by items recognized in the income statement. Additional paid-in capital, APIC, arises from share issuance transactions and certain equity transactions such as stock dividends. Some transactions affect both accounts, while others affect only retained earnings. The objective is to identify the transaction that changes retained earnings without changing APIC. A declaration of a small stock dividend. Incorrect. For a small stock dividend, generally less than 20 to 25% of outstanding shares, retained earnings decreases by the fair value of shares issued. Common stock and additional paid-in capital increase. Therefore, this transaction affects both retained earnings and APIC, so it is not the correct answer. B. Decrease in the value of an available-for-sale investment. Incorrect. Under traditional US GAAP, unrealized losses on available-for-sale debt securities are reported in other comprehensive income, OCI, rather than retained earnings. They accumulate in accumulated other comprehensive income, AOCI, not retained earnings. Therefore, retained earnings is not directly affected. C. Impairment of a long-term asset. Correct. An impairment loss is recognized as an expense in the income statement, reducing net income. The impairment has no effect on APIC, making this the correct answer. D. Purchase of treasury stock using the cost method. Incorrect. Under the cost method, treasury stock is recorded as a contra-equity account. The purchase reduces total shareholders' equity, but does not directly affect retained earnings or APIC at the time of purchase. This question tests students' knowledge of the key differences between US GAAP and IFRS in inventory accounting. The phrase, fundamental difference, signals that students should recall one of the most commonly tested distinctions between the two accounting frameworks. One of the best-known differences concerns inventory write-downs. Under US GAAP, if inventory has been written down because its value declined, the write-down cannot be reversed, even if the inventory subsequently recovers in value. Under IFRS, if the circumstances causing the write-down no longer exist and the inventory's value increases, the previous write-down may be reversed, but only up to the amount of the original write-down. Students should also remember another inventory difference. US GAAP, lower of cost or market, LCM, subject to ceiling and floor rules for many inventories. FRS, lower of cost or net realizable value, LCNRV. A reversal of inventory write-downs is prohibited under US GAAP, but is permitted under IFRS. Correct. This is a well-established difference between the two frameworks. US GAAP, inventory write-downs cannot be reversed. IFRS, reversals are permitted when net realizable value subsequently increases, limited to the amount of the original write-down. This statement is correct. B. Distribution costs are included in cost of sales under US GAAP, but are excluded from cost of sales under IFRS. Incorrect. Distribution costs, selling and delivery expenses, are generally treated as selling expenses under both US GAAP and IFRS and are not included in inventory cost. C. Inventory is generally valued at the lower of cost or net realizable value under US GAAP, but is generally valued at the lower of cost or market under IFRS. Incorrect. This statement reverses the standards. US GAAP, lower of cost or market, LCM, traditionally. IFRS, lower of cost or net realizable value, LCNRV. D. Marketing costs are included in cost of sales under US GAAP, but are excluded from cost of sales under IFRS. Incorrect. Marketing costs are generally selling expenses under both accounting frameworks and are not included in inventory cost. Correct answer. A. Reversal of inventory write-downs is prohibited under US GAAP, but is permitted under IFRS. A useful memory aid is: IFRS can reverse, GAAP cannot. This distinction is one of the most frequently tested differences between US GAAP and IFRS, making A the correct answer.